coffee first. After being formed, it is inevitable that a corporation may need to raise additional capital to fund its operations. There are two basic methods that a corporation uses to raise money: debt financing and equity financing. An issuer that sells the bonds borrowing money from the investors who buy the bonds. The bonds are borrowed for a predetermined period of time, and a corporation needs to make interest payments to the investors over the life period of the bond. Bondholders are not considered as owners, and therefore they have no voting rights. For bond investors, their returns are limited, and the corporation pays to investors to be able to use their money. But we are not talking about the bonds today and debt financing. Hello everyone, this is Alex, a private investment advisor, currently work and live in Portugal. I have a small disclaimer: everything I say in this video or in future videos should not be considered as an investment advice in any form. I required to say so due to certain licenses and certifications I have. Thank you, and let's get started. The other way for a corporation to raise money is to issue a stock. Unlike bondholders, investors who purchased a stock become part owners of the corporation. Stockholders don't receive guaranteed interest payment, and they have no certain maturity date. So you can ask, what's the upside for the equity investors? If a company prospers, shareholders may expect some benefits from the corporations, like dividends or stock appreciation. However, if the company fails, the shareholder more likely than other investors may lose all their investments. This is due to the fact that a corporation needs to liquidate their funds under bankruptcy. Bondholders and other creditors have higher claim to company assets due to bankruptcy, and they will be paid first. There are two main types of stock that corporation may issue: common and preferred. Common stock is a traditional and most widely used type of equity, and common shareholders are last to be paid if the corporation declares bankruptcy. Common stockholders may receive dividends, but only after corporation bondholders receive their interest payments, and after preferred stockholders receive their dividends. For bookkeeping purposes, common stocks is usually issued with a face value or par value. That's an arbitrary amount, and it's used for companies' financial statements. There is no relationship between par value and market value of the stock. The second form of equity is preferred stock. In the capital structure, preferred stocks are considered senior security above common stockholders. It's still below bondholders. The name preferred is derived from the fact that these owners have a preference over common stockholders regarding receiving dividends. Preferred stock is often issued by established companies that already have common stocks outstanding. These shares are more suitable for investors who are more interested in income than capital appreciation. Also, preferred shares generally lack of voting rights. Cumulative preferred stock. What happens if a corporation fails to pay a full dividend on its preferred stock? If preferred stock are cumulative, then all unpaid dividends that owed by the company have to pay in future before common stockholders receive any dividends. Most preferred stock is cumulative. Non-cumulative preferred stock describes preferred stock that does not pay stockholders any unpaid or omitted dividends. Callable preferred stock. A company that issues a callable preferred stock has the right to repurchase stock from the investors at a specific price at the same time in the future. In order to induce investors to buy the stock, the call price is typically higher than stock's par value. Convertible preferred stock. The investor who wants a greater potential for capital appreciation than preferred stock usually provides. Convertible preferred stock may be a suitable choice. The trade-off is a lower dividend rate that's what usually offered by another preferred stocks. Investors who purchase convertible preferred stock are able to convert a par value of the preferred stock to predetermined number of common stock at a specific price. There are also a huge number of type of securities. Today we just talk about two of them, common and preferred stocks. There are also like ETFs, warrants, rights, and so on and so on. I hope you enjoyed this video. Thank you. Until then, spend your money well.